You know, when a geopolitical crisis just explodes onto the world stage, the headlines get pretty terrifying, right? And the markets seem to react in perfect, scary lockstep. But what if I told you that the big, scary story isn't the one that professional investors are actually worried about? Today, we are going to peel back the layers on a major global event to find out what truly moves the market when everyone else is panicking. So let's set the scene. Imagine this. After being open for less than a day, Iran slams the door shut again on the Strait of Hormuz. And this isn't just some waterway, it's a critical artery for global trade. Suddenly, tankers are getting attacked, the US and Iran are in this tense standoff, and nobody really sees a clear path to calming things down. It's exactly the kind of news that sends a shiver of uncertainty across the entire globe. And the immediate fallout, well, it's exactly what you'd expect. Oil prices just shot through the roof overnight. We're talking about both West Texas Intermediate, that's the US benchmark, and Brent crude, the international one. And listen, this isn't just some abstract number on a screen. This hits you and me directly at the pump. US gas prices are already up 40% from where they were before this all started, which of course skips everyone talking about inflation. Predictably, the stock market got spooked. The S&P 500 and the Nasdaq both dipped as investors started selling. It's that classic knee-jerk reaction to fear, right? At one point, the Nasdaq was down almost a full percent. This is like textbook response to a big geopolitical shock. But then, something kind of interesting happened. Okay, so here's where the story takes a turn. While all the headlines are screaming chaos, Wall Street analysts like Adam Crisafulli were surprisingly calm. His take? He said that despite all the noise, the real movement here is towards de-escalation. The pros seem to believe a deal will get done, or at the very least, things will cool off. Which, begs a really important question. So wait a minute. If the people whose entire job it is to price risk aren't panicking about the biggest headline in the world, what are they actually looking at? This is where our whole story pivots. We're moving away from the news you see on TV and digging into the numbers that truly matter. We're going from headline risk to something much, much deeper. And that something is what we call fundamental risk. Now, this isn't about external shocks like wars or surprise events. This is all about the health of the market itself. Think of it like a pre-existing condition. Are stocks just too expensive? Is the whole market being propped up by just a tiny handful of winners? These are the kinds of questions that actually keep serious investors up at night. So let's start with valuations, the price tag on the market. This number, 20.9, is the S&P 500's forward price-to-earnings ratio. To put it simply, that's how much investors are willing to pay today for every dollar of expected future earnings. And a higher number means stocks are more expensive. Right now, that 20.9 is way higher than the 5-year average and the 10-year average. So the bottom line is, stocks are pricey. But honestly, it gets even more concerning when we start to look under the hood. Because this isn't just about high prices. The real danger here is that the market's strength might just be an illusion created by a tiny, tiny group of companies. The profit growth that's supposed to be justifying these high prices, it's not spread out at all. It's dangerously concentrated in just a few pockets of the economy. And this problem becomes crystal clear when you break the market down by sector. You've got profit growth expectations just soaring in 3 areas: energy, IT, and materials. But what about the rest of the market? Think healthcare, financials, consumer staples. They're all lagging way behind. It's kind of like the market is this giant engine that's only firing on 3 of its 11 cylinders. That's not a healthy engine. And it gets even crazier when you zoom in on individual companies. Get this. According to Goldman Sachs, the recent upgrades to profit forecasts for the entire S&P 500 are more than 100% due to just the top 10 stocks. Now, you might be asking, how is that even possible? Well, it means that if you take those 10 companies out of the equation, the profit outlook for the other 490 stocks is actually negative. They're dragging the average down. In fact, just one company, Micron, is responsible for over half of the entire market's positive revisions. It's wild. And this concentration risk exists even among the market's biggest stars. I mean, we all hear about the Magnificent Seven, right? Their combined earnings growth looks amazing, almost 23%. But take out just one company, NVIDIA, and that awesome growth rate collapses to a pretty measly 6.4%. This just shows you how fragile the market's good news story really is. It's a rally built on a very, very narrow foundation. So this brings us to the key takeaway, the tale of 2 risks. On one side, you have headline risk. It's dramatic, it's loud, it's all over the news, but the pros often see it as a short-term problem they can manage. But on the other side, you have fundamental risk. It's quiet, it's buried in spreadsheets and data, but this is the long-term structural weakness that has the real power to decide whether market goes from here. So ultimately, the market is making two absolutely enormous bets right now. It's betting that the geopolitical situation will calm down and keep oil prices from going crazy, and it's betting that this AI-driven boom, led by just a couple of superstar companies, will basically go on forever. The final question we all have to ask ourselves is, what happens if it's wrong about just one of them?